There has been a lot of interest in short selling lately. So here I just wanted to talk about it from a more objective and academic fashion. What is short selling? Why does it exist? What is the so-called short squeeze? No, this is for educational purposes only and should not be treated as financial advice. For a better understanding, we first look at what it means to actually own a stock. When we bought a share of stock, say Amazon or Apple or some smaller company, traditionally it means we bought a share of the ownership of the business. And it comes with a voting right, dividend share, and so on and so forth. But these days, it depends on the class of the stock and the specifics attached to that class. So instead of sharing the ownership, the value is only in the price of the stock itself. When you buy a stock or go long on a stock, it usually means you believe in the business. You may think their senior management team is strong, or the company has shown great growth potential, or maybe the economy is strong and you think the company will also do well in such economy. So you believe the stock price will rise and you want to put your money to work instead of letting it sit in the savings account with miserly low interest rate. In other words, traditionally this is more of a proper investment. You purchase an asset with your money and expect the asset value will grow. But what does it mean to short a stock, considering there's no opposite of owning a share of some business? Let's first consider a scenario. Say you find a company whose stock you believe is completely overvalued. The price is too high. Maybe you discovered that the firm is just poorly operated, or their business model is now outdated, or worse, they may have committed fraud. And you believe that their stock price will fall, maybe soon. Now, if you already own the stock, you can sell how many shares you have. Maybe you take some profit, or you want to prevent potentially more losses. But what if you do not own it, but want to take advantage of the extra information you collected? Can you sell a stock you do not own? Here enters the idea of short selling a stock. Since you do not own the stock, but you want to sell it, you need to borrow the stock from your broker. In the future, hopefully you're right and the price will fall, you will need to buy back the stock and return it to your broker. Maybe you need to pay some interest as well, since you effectively had a loan. Since now you are buying a stock with a lower price, you are effectively returning less money than what you borrowed. You can pocket whatever the difference is as a trade profit. To analyze the profit and the loss of shorting a stock, we'll use Apple as an example. Kind of stupid, right? Who would short Apple? But for the sake of argument, we'll just use it as an example. First, let's think about the potential maximum profit. Since the stock can't go below zero, the maximum profit is the price of entry when you short it. The potential maximum loss, on the other hand, shows how dangerous the short trade can be. If the stock keeps rising, the potential loss, theoretically, can be unlimited. Let's imagine a specific scenario. You enter a short position in Apple at $50. When the price falls to $40, if you cover your short position, you will make $10 per share. But you decide to keep it. And when it rises to $100, if you cover it now, you need to spend $100 to buy back the stock to return it to your broker. You will suffer $50 loss per share, meaning you would have lost all your initial investment. If your account has a lot of cash and there's no margin call, and you decide to hold on to your bet, when the price rises to $130, you will lose additional $30. So you have lost more than your initial investment already. This seems fishy, right? You're not really owning anything. Everything seems like a game. You may ask, is allowing to use short selling to bet against a company even legit? Why is it allowed? If you are academically curious and did some Googling and research, you may have found a lot of studies by renowned economist scholars that say short selling is an important part of financial market. It helps improve the market efficiency, including bringing price to fair value, increasing the liquidity, and so on and so forth. There's also evidence that shows it helps with corporate governance, acting as an external discipline mechanism. Since it helps expose fraud, the managers would try not to conduct shady behaviors, for example. In fact, even Warren Buffett says they have no objection to anybody selling Berkshire short at all, since they have to buy the stock back after they're short. They will create demand for the stock later on. He also says huge short interests very often have been later revealed to be frauds or semi-frauds of those shorted companies. One example is the famous or infamous short seller Jim Chanos once shorted Enron when the company was seemingly doing really well. But Enron collapsed in late 2001 after revelations of a massive accounting fraud. I, however, want to briefly mention the necessity of short selling from the perspective of quantitative finance. It is in fact a necessary assumption in most basic quantitative models. For example, in Black-Scholes, it is to assume it's allowed to buy and sell any amount, even fractional of stock. If we look at a more practical example, say you buy a call option, nothing complicated. Unlike those complex products people came up with that smell fishy, like subprime, mortgage, CLO, etc., call option is the simplest derivative retail investors often use for their investment. Now, if you want to protect against losses when the stock price falls, you don't want to lose all the premium you paid. What do? You need to short the stock. So when the price falls, while your call option loses value, you gain from your short position. In fact, this is the basic idea of so-called delta hedging. Now, short squeeze. You may have heard of this most recently because of the Reddit frenzy around GameStop, AMC, or even silver, a commodity. What is short squeeze? It's the scenario when the price of a heavily shorted stock rises rapidly, and short sellers are forced to cover their positions due to large losses and possible margin calls. Because the short sellers have to cover their short positions, this creates more demand for the stock and drives the price even higher. So the early rise of the price squeezes the short sellers out. That's the name, short squeeze. Short squeeze, just like many other disruptive or semi-disruptive events, is an opportunity for great profits and losses. Let's use Intelsat as an example. In a few months after June 2018, Intelsat went from below $3 to above $30, an increase by tenfold. In situations like this, who would make profits? First, obviously it's the early buyers, and if they get out early. And also the late short sellers who enter their short position when the price has gone up so high and eventually comes back down. And who would suffer losses? First, early short sellers. They are the ones that were squeezed out, so to speak. And then the late buyers who bought the stock when the price has gone up so high and again eventually comes back down. It's worth noting the early short sellers may just come back in later if they have deep pocket, so they can potentially recover their losses and even profit from this whole event. Imagine a scenario. Five hedge funds were early short sellers who suffered large losses during short squeeze, but another 50 went in with new short or put positions near the peak and made great profits after the squeeze. Those 50 may include the early 5 if they have deep pocket. So likely, it's only the late buyers, mostly small retail investors, that would suffer large losses because they came in late. So, short squeeze is a very risky game to play for most people. That's what I wanted to talk about in this short video. What does it mean to own a stock? What does it mean to short a stock? Why does short selling exist from the perspective of quantitative finance? And what is short squeeze? And why is it a dangerous game that can generate large profits but also losses? Okay, hope this is helpful and thanks for checking it out.